Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jake-amp-gino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Make it happen, Stenziano. Doing good, bro.
That's my line, baby. Come on, make it happen now. Today's guest is John Azar. John is the Executive Vice President of MAC Venture Partners, a private equity commercial real estate investment firm located in Charlotte, North Carolina. John's firm currently controls nearly 5,000 multifamily units. I like that.
5,000,
very
bro.
good.
Thank you, guys. Wow, that's quite the introduction.
5,000, big number. So, John, talked to you a little bit earlier, banking in your past and transition to commercial real estate. Can you talk to us about that move and why you made the move from banking to get into the commercial real estate sector?
Yeah, I mean it's look, I started out in investments. My almost my entire professional career have kind of been in the investment and finance world. Back in the day in 2000, 2001, I started out with Morgan Stanley in wealth management, and I was slinging stocks and bonds and making about 250 phone calls a day. So that's how I got started in the business. And sort of my path kind of led me through the investment world, and eventually I launched a couple of different companies, a couple of different consulting platforms. Right after leaving Morgan Stanley, actually, I launched a consulting platform for mixed-use development, real estate development, large-scale mixed-use real estate development with two other partners. And we had projects anywhere from Boston down to Miami. We even had a project in London that we consulted on. So. And then towards the crash of 2007, 2008, we had to switch gears, and we had to get day jobs again, and we
that sucks.
Yeah, no, I know. So we went back into some of us went back into investments. I ended up between investment. I did a stint in venture capital. I did a couple of stints in commercial banking before I sort of made my way back into real estate here with my brother.
Big question for me is, why real estate?
Well, look, real estate has always been a major wealth driver for everyone. I mean, real estate is one of those sectors. Even back when I was selling investments, is one of those sectors where you allocate little, but you get a lot. And your allocation to real estate looks completely different than any other allocation in your portfolio if you were managing, let's say, a complete stocks, equity, and bond portfolio and real estate, or what's called alternative assets. Real estate, unfortunately, always falls into alternative asset category. And I say unfortunately because alternative assets, historically, when people hear the term alternative assets, they think of high risk or very high risk investments. And real estate is not. Real estate is actually the opposite of that. It's got a lot lower beta than sometimes even bonds. Definitely stocks. I mean, it beats stocks by far shot. And beta, meaning the risk, is what I meant. I revert back to my investment days. But so your beta on real estate will always outperform anything else. Your alpha or your performance on real estate is not going to be your 30, 40%, 50% that you get from investing in small cap stocks. But if you get 10 to 15, 20% performance, hey,
with little risk, I think you take that all day long, right?
Or beta, why wouldn't you? I mean, it seems like a no-brainer. So really, that's why real estate to me. I mean, I got into real estate on and off in my past 15, 18 years career. And a few years ago, my brother launched a firm in 2007, commercial real estate firm that we have now. He kind of started growing it. It was a family business, and about 3 years ago, we started talking about how we could combine forces, and
Can you tell us what your first deal was? I mean, go back all the way back. I mean, what was the first deal that you got into real estate?
Oh God, yeah. Going back all the way, it was actually the deal that got me into real estate, or got me excited about working in real estate. Is a large scale, and it's probably not a fair deal because it kind of tainted the water for me. It made me shoot way high, and set my expectations way above what should be set. It was a large mixed use development deal in Miami that came to my team when I was working at Morgan Stanley in structured finance. And it was a $1.2 billion deal for this guy that was trying to build the largest, tallest commercial residential tower in Miami at the time. This was back in 2004, 2003, 2004. And we worked on it for a year and a half, brought anything from Pavarini Partners to Ian Pay to Related. I mean, you name it, it was the people were involved in this deal. The land was acquired, but it stalled, and then at some point it just broke down. It didn't work. But that deal really kind of taught me a lot about real estate, a lot about sort of getting your team together, getting the right players together, and being in a room with people that are a lot smarter than you are. And that's really what sort of made me think, hey, maybe I could do this. I'm sitting here in this room with these guys. They don't think that I'm green as a blade of grass, but I'm somehow getting it done. So that was really the first deal. It was a very, very interesting, very complex deal. But that's why I said it set the bar really high for me. And then from there, I just kind of started working on different deals. The consulting firm I launched after that really worked on these type of deals, a lot smaller, but they're mixed-use development deals. Some of them are waterfront. Some of them have contamination issues, greenfield, brownfield, greenfield issues, and especially in the Boston area, Philadelphia area, we had 2 projects in Boston that were contaminated, brownfield issues, very complex that had involved a lot of different players. We had my very first deal that I got done after launching my firm. So this was my deal. This was not somebody else's deal. Was a luxury condo conversion project that was bought from Simmons College in Boston.
How'd that go? I feel like everyone always has a good feel going into these condo conversions, and then it usually sputters or they don't really.
It's market timing.
Yeah,
it's market timing. Yeah. It's market timing. I think after the deal was done and consummated and it was built, they were. I'm sure we were probably getting cussed out because it was after it was finished and built. That was 2006, something like that. So they stalled. They stalled in selling it for a while. I think from what I remember, the last penthouse got sold in 2008, 2009. So it took them almost 3 years to do full sales on these things.
Wow.
They brought it to market at the absolute worst time, but hey, we got paid out of it.
John, can you just go over your investment strategy now? I'm going to go over how you've changed, but I really want to just chunk down how your investment strategy is now, what you focus on now.
Sure. We focus on and I hate to say value add because it's such an overused word in real estate, especially in commercial multifamily real estate. But really, we focus on opportunities that create the most amount of returns for our investors, and that's my definition of value add. And those type of returns to our investors, usually are found in the B class and C class conversions that we do. We generally take a C minus, C plus, turn it into a C or C plus or B minus. We take a B minus, turn it into a B plus. Those are the type of opportunities we look for. We look for anything in an area that is somewhat of a non-core area. So any secondary, tertiary markets, we're not scared of them. We love secondary, tertiary markets. In fact, we look for, as long as there is there has to be 3 components to what we look for. There has to be some kind of a job center, job driver nearby. Mm-hmm. It doesn't have to be in the exact city or town that we're looking at, but it has to be within driving distance, creating commuter traffic, or anybody who may live in our communities, maybe a commuter to that nearby job center. There has to be decent schools. and there has to be a proximity to either shopping or dining or something that essentially create that.
Get those retail workers in there, right?
Yeah, exactly. Because look, I mean, our demographic for most of our apartments, they're making, as far as wage is concerned, they're making anywhere between, I'd say the average is between about 28,000 and 45,000. That's the average.
Like $10 to $25 an hour, something like that.
Yeah, exactly. So you gotta look for. You can't buy something that is you got farmland for 20 miles around it and expect that you're going to get anybody to live in those communities. It's not.
And you're not. Those folks aren't renting the $1,500 a month apartment either.
No, they're not. So if you're selling B and C apartments, that's not the market you're going after.
John, let me ask you, typically, like you said with value adds, what type of value adds do you look for? Like Jake and I look for, let's say, rubs. We can add rubs to a property. We can increase the income, raising the rents, lowering expenses. What type of other value adds do you look for in properties?
Yeah, I mean, our typical structure is we like to get something that has we spend anywhere between $2,500 to $10,000 per turn for when we look at what.
And he's saying per unit he's investing $25,000 to $10,000 per unit.
Per unit,
yep.
That's right, per unit.
And I'm just clarifying for some of the folks out there. Yeah,
that's right. That's right. And that involves anything from floors, cabinets resurfacing, countertop resurfacing, fixtures, bathroom fixtures.
Guys, I just want to hop in one more time for the listeners, because this is what thing he said is very important, is the resurfacing, because you go in and resurface these countertops. If you're just going to add Formica, but you just go in and resurface, instead of pulling stuff out, resurfacing is huge and really can cut your expenses dramatically on a turn. So he brought up a great point there, and I just didn't want to have the listeners miss that, because it's huge going in, especially if you're doing your first 30 unit or something and you're going in. Don't go ripping out all the cabinets if you can resurface or paint these. It's going to save you a ton of money. So that's a great point. Sorry to interrupt, John.
Absolutely. No. Absolutely. No, that's a very important point to know, actually, because resurfacing is a fraction of a cost of what it would cost you to replace the countertops or cabinets.
Yep.
Countertop resurfacing really comes really nice if you you've got to check into a couple of different. There's a lot of sort of granular resurfacing that make it look almost like granite, but it's obviously it's not. But if you do it right, it should come out pretty nice looking.
Yes.
And most of our renters love it. So, and from also a continuous repair standpoint, if it's resurfacing, you just go back. If something happens during a turn, or you need to repair a chip here and there, you just go in and repair it within an hour or less than an hour, and you're done, as opposed to having to replace a whole cabinet or a countertop.
This is why John focuses on B's and C's, because we can do these type of repositionings on the B and C. If you're going into an A, he's probably going to have to put in granite. He's probably going to have to upgrade with the cabinets, so it's going to cost more than $25,000 to $10,000. What do you normally see in a rent bump if you're going in and putting that kind of investment in a property? What do you normally want to look for in a rent bump?
We want to see anywhere between $60 to $120, $130 rent bump.
That'd be great.
So, and that's not adding in anything that's not adding inflationary upgrades that we do or inflationary rent bumps that we do on a regular basis, which average about 3%. So on a regular, even if we don't do anything, we're bumping up rent by 3% just to keep up with inflationary demands up.
This is great, Jake, because this is our strategy. So I think we're doing something right by following the guy who's got 5,000 units. We've got the same framework laid out. How has your investment strategy changed over the last 5 years? Because it looks like you were doing more commercial, mixed use, and all that. Now it seems like you're focusing all on multis. And how and why is it focused on multis now?
Yeah, we've even changed in the past just 2 or 3 years. We used to, when we first got started in multi, we were picking up anything and everything, not anything and everything, but we're picking up 30, 40, 50 units, complexes, 80 unit complexes. We've kind of sold off. We burnt off a lot of those smaller acquisitions now in the past few years. And now our portfolio only contains 100 unit plus in it, assets. And we don't want to pick up anything less than 100 unit anymore moving forward. We've changed just because and that change really is not because we were too good to pick up anything below 100 units. It's really more of an efficiencies standpoint from our work staff. We've created teams that go around our different apartment complexes. We have our own work crews. For us to buy something less than 100 units, it just doesn't make sense. It's not efficient anymore for us to send 2 or 3 trucks to service, a 40-unit complex when we can service a 200-unit complex. So that's really why.
Before we get into the building teams, I wanted to ask you, since you've got such a great knowledge and you've been around, what do you think about this election and Trump going in? How is he going to affect multifamily, and what do you think going forward?
He's like, don't ask me that, man. I'm trying to keep everybody on the up and up here. He's like, don't ask me, man.
And I'm like, WTF, man? Are we going there?
We're not politicians. We're not advocating for either side.
Let's
We're
keep
just
it
being
objective.
realistic.
Yeah.
No. Look, it's a fair point, and it's funny that you say that, because just in the past week and a half, we've seen rates skyrocket.
Yep.
I mean, we had some quotes. We just closed yesterday on a 145
Awesome.
unit complex in
I hope you rate locked about 60 days ago.
We rate locked it. Believe it or not, about 5 days or so before the election.
Good for you.
So it was just.
That's why the guy's got 5,000 units right here. All right, a little bit of luck sprinkled in there.
I mean, it was a doozy, man. We rate locked it at about 405.
Nice.
And rates right now are about 4.7, 4.8. So
what was your spread? What was it, like 225 over the 10-year on that, or how much was it? Do you know?
What is that? On our base on this?
No, how many basis points over the 10-year you think you were on that one? 225 at the time of your rate lock?
Probably. Yeah. I haven't looked at the calculation, but that sounds about right.
Yeah.
I mean, we generally, so what we look for as far as financing is concerned, we generally like to see anywhere between 7 to 10 year and 25 year amortization for those of you who don't know what AM is.
So is that why 25 versus 30? You just want to pay more you want to get more principal pay down, or?
Yeah, it just happens to be that's how it lays out. A lot of times a lot of what we deal with is agency debt. So we deal a lot with Fannie and Freddie debt,
Yeah.
and just a lot of the programs out there. That's what they offer. 25. Yeah. We rarely see 30.
Gotcha.
Most of what's out there is 25 if you use Fannie debt.
So I'm not going to skip the Trump thing yet. I'm going to go back to that. How did you find that 145 units, and what was attractive about that? Since it's happened just now, what did you like about it, and how did you find it?
Yeah, so that one actually is an interesting off-market deal, and off-market, everybody tries to find these unicorns off-market deals, and they don't come around that often. They just don't. That's why we have a relationship with a ton of brokers, because we can't find off-market deals. But every now and then you do look out and find that unicorn. This one came through us from a broker, actually, who knows a company. It's a Chinese company that owns this complex, and they're not in town. He's got a great relationship with them. They came to them and said, we want to sell this property, but we just don't want to go through the pains and hassle of showing, and you know anybody that we can just unload this off market. So he came to us and said, I have this great complex. Here are the numbers. I can give you everything. I still got to get paid, but it's yours with no competition. So that's ideal for us. We love seeing those kind of complexes, but that doesn't come around that often. So we got this through him. So we're still on the financials. You're still going to show about $110,000 commission, but it's not because it's marketed. It's still an off-market deal, but we have to pay so much to get it off market. Yeah.
So you assume that loan, or was that an assumable type transaction?
No, brand new. It's brand new. Yeah, we don't.
The same one we were just talking about, right?
Yeah.
But what attracted you to that deal? What made that deal attractive to you? What were the value adds, as you would say?
Yeah, so the area is great. It's located at a really nice. Around it is very nice residential areas, very close by to shopping, higher education, university. It's about 10, 15 minutes away from you. It's 10 minutes, less than 10 minutes away from UNCG, University of North Carolina in Greensboro. Shopping, schools are great. Commuting to different job centers, health centers, and it was a little bit slightly lower in market rent than its peers around it. We usually we do comparisons, obviously, with different areas. We do usually go. We'd like to stay within 3 or 4 mile radius when we do our comps. Sometimes we are not able to find anything within 3 or 4 miles, so we go out 6, 7, 8 miles. And that's what happened with this one. We had to actually go out about 8 miles, 9 miles to find anything comparables to it. And the comps were showing us that it was about 20. There's about 20% disconnect from general market. And that's not even us doing anything. I mean, if we were to even just raise the rent, compete with other ones, we could raise the rents about 10-15% without even having to touch it. So when we institute our rehab program, we would be easily looking to just to match the market and maybe charge a slight premium for some of the newer rehab units. It became a no-brainer for us from a financial standpoint.
So, John, this was a motivated seller, correct?
Motivated seller.
So Jake, mom and pop, 145 units. That's what Jake, we like to call these mom and pops because they're motivated. They're out of town. They just want to get rid of it. And I think people underscore, they don't really think of that. And the other point is that you have broker connections. Everyone is always asking us, how do you find these deals? It's very simple. Show guys that you perform. Show guys you're going to do what you say you do, and they will bring you the deals. And that's what John's, I guess, up his alley. That's his strength. He's looking at these B's and C's. So brokers know what his deal is, know what his investment strategy is. They're going to go to him first and let him look at the deal. So, guys, it's really important that you get those broker relationships going. Right, Jake?
Absolutely. It's very important.
Now, let's get back to Trump.
Broker relationships are essential, Gino. I mean, you hit the nail on the head. Without these broker relationships, we wouldn't be getting half those deals that we got.
Everyone's, I can't find a deal. I can't find a deal. Well, how many brokers you had lunch with last week? That kind of thing. So
yeah. So let's piggyback off that. How do you create these broker relationships? Because what Jake and I like to do is we have a credibility book. We'll go out. We'll look at what the top 3 or 4 brokers in our market are. We'll talk to them. We'll send them over our credibility book. Let them take a look at our portfolio. Let them take a look at our investment strategy, and just have a frank conversation and learn the lingo and let them know that we sort of know what we're talking about. How do you start building relationships with brokers?
Yeah, I mean, it's same thing, man. Same thing. You just you build them one at a time, and how do you eat a whale one bite at a time? I mean, you can't all of a sudden go out there and have a Rolodex of 20 different brokers and all of them are going to love you and suck up to you when the deal comes up. That's just not going to happen. It's going to take time. Mm-hmm. You show up. You go to there are a ton of events out there, networking events that you can go to. Brokers love to network, so you don't even have to do any effort to actually get to network with brokers because that's their natural habitat. They love to network, and a lot of times they have events that they sponsor themselves. See if you can get yourself invited to those kind of events. Anything from a luncheon or whatever it is, even if you think it's somewhat benign to you or you're not really interested that much in the information, go show up to these events because at the end of the day, you're shaking hands and you're making connections with these brokers. They're remembering your face, they're remembering your name, and it's consistent. So you have to do it over and over again. And then at some point in the course of time, they're going to start remembering your name. They're going to, when you show up to the event or even when you don't show up to the event, they're going to say, oh yeah, this guy, Gino, I remember him. He showed up a couple of times and he sounds like he's got something going on. Why don't we just start shooting some deals? So it's really over time. That's really the concept of networking in general. It always astounds me when I hear people that they say, "Oh yeah, I went to this event. It's not for me." I'm like, "Well, how many times did you go to it?" Once. Okay. Well, what do you expect is going to happen? I mean, you expect Cinderella's going to walk down and all of a sudden you're going to find a ton of money out of it? I mean, it's networking events are consistency. They're all about consistency. You have to show up, give it some time. Even if you don't like it, just give it some time to actually see if it actually yields you any results or not. And that minimum point for me, historically, have always been anywhere between 6 to 10 months. Give it 6 to 10 months. Maybe even up to a year if you somewhat like it. If you don't like it, if you go into like a BNI event or something like that, and you just absolutely hate it, just change it, go to something else. But if you're going to something that you are somewhat is interested in, just stick it out for at least 10 months and see what comes out of it.
Let's get back to the current economy. As far as Mr. Trump, what do you see going forward? We already saw a rate rise. We're probably going to continue to see that. I don't see that going away anytime soon. Everybody know that they can get away with charging 4.8 as opposed to 4.2. Why would they go back to 4.2? And we haven't even hit December yet, which is when the Fed fund rate announcement is going to happen. I don't know if the Fed fund rate is going to go up or not. I don't know if the Fed committee is going to raise the funds or not. They're expecting it, but
all the economists have been wrong in the past couple of years as far as when the Fed fund rate is going to go up. If they do go up, then those rates are going to only go higher. They're not going to go lower. So I think in the next 10 months or so, 6 to 10 months, you're definitely going to see a capitulation on prices, meaning it's going to become more and more, we're heading more towards a buyer's market as opposed to a seller's market, which is what we've been in for the past 2 or 3 year cycle, 4 year cycle. It's only natural that prices are going to start to contract as rates start to go up. And the first hit of those prices are going to be the A properties. That's why we stay away from A properties. Those guys who have bought A properties and over leveraged themselves, and they barely just kind of skimmed the surface on getting 85, 90% leverage, getting into something over their head, they're going to be underwater in no time in the next 6 months.
It's going to be interesting. Even when their notes are coming due and they were squeaking by with a 4% rate, what's going to happen if that goes up to 5 or 6? That could be an interesting thing to watch out for. Maybe create some opportunities for some folks.
Oh yeah, absolutely.
But John, what's going to happen with with all that cheap money? We're talking about if you can build at 125,000 a unit, but you're getting cheap money. But what's going to happen to that now going forward? There's no cheap money anymore, and so what's going to happen to that A market? Is it just going to dry up? Are they going to go vacant? I mean, what do you foresee happening in that respect?
No, I think you're going to see. I mean, in the A class, you're going to see a lot of concessions. They're going to start giving out concessions like candy.
Yeah, that's going to hurt us a little bit potentially.
Mm-hmm.
Of course. B and C are always going to be laggers and taking a hit because look, they're not as expensive, so they don't. Landlords don't have to do anything. They're already accommodating a lower expense ratio type of renter from a higher expense ratio type of renter from an A property. So you don't have to. They don't have to do that much of an accommodation. Will they take a little bit of a hit? Yeah, I mean, if the economy really takes a dump, then yeah, we will start seeing a trickle down to the B and Cs. But I don't see it right now. I mean, stock market is jumping for joy, So the bond market is gonna be on the rise. Yeah, so that's gonna affect the rates for us. But in general, if the stock market is any indication of what the general economy is going to do, probably going to be okay. I mean, we're not looking at a cliff scenario here. We're probably looking at a correction scenario, not a cliff scenario. So right now we're at the top of this cycle, but the top is very flat, and we're kind of been cruising along at this flat top for a while. At some point, that flat top is going to come to an end, and I think that point is coming pretty soon. Now that with this election is over, 2 months ago, I used to think that flat point is going to end in 12 to 18 months. Now I think it's going to end in about 6 months, 5 to 6 months. So I think by March or April, you're definitely going to start seeing more movement of buyers and moving on properties that are taking advantage of some of those disconnects now in the marketplace. You're going to start seeing a lot of those IO deals, interest-only deals that have been consummated about 2 years ago, now coming due anywhere between 12 to 24 months ago. Those notes are now coming due, and the IOs, the interest-only deals is burning off, and then they have to start paying some real money and real pain. So you're going to start seeing those units being back on the market. There's going to be some good deals, man. There's going to be some good deals after, I think, March, April, or maybe May timeframe. So
let's rewind. Let's say Hillary Clinton had won. What would you have seen? Would there have been a difference in going forward? Because I was watching elections at nighttime, and I remember the futures were down 700 when they announced that he had won. He had a 91% chance. What would you have seen if she had won? Is that why you're thinking 12 to 18 months? Would this have taken longer to consummate if she had won?
Yeah, I think so. I mean, I think I go back to that what we believed that was going to happen before. We're probably going to look at a 12 to 18 months burn off of some sort. We're still going to be looking at a scenario where some of those IOs are going to come due. We're still going to be looking at a scenario where some of those deals that were made back in 2009, 2010, 2011 and are now coming due, and they're going to have to refi or just get out of the deal in general. So we're still looking at similar scenarios. Mm-hmm. It's just now the timeline, I think, shrunk a lot. It's been contracted a lot by this election, and we're no longer, I think, looking at just a tepid 2% growth environment for the next 2 years. I think you're looking at probably a little bit more than that. So, as much as I maybe like or not like saying it, I think this election is going to probably prove to be better for our market than, well, at least for the buyers end of it, than people had expected before.
You've scaled up to 4,000 units, and I know I spoke to you a little while ago. You want to go up to 9,000 units, correct, by the year 2020? I remember talking. How have you built teams to actually just that massive scale? Because, I mean, Jake and I, we've only done 678, 700 units in 3 years, and we're scrambling with a small little team. How have you been able to, build your teams to support that growth?
We built it slowly, but I think every company comes to a certain inflection point in their growth where we have to kind of rethink of how they're going to handle their growth, how they're going to handle the next really stage of their evolution. We're hitting that point almost. We're almost at that 5,000 units. So that's a major inflection point in people like us. And so there are a couple of different inflection points. There's an inflection point when you hit the 5,000 unit. There's another inflection point that's going to happen when you hit 10,000 units. And there's probably going to be another inflection point that happens when you hit 15 or 20,000 units. And each inflection point in that growth really demands a complete reshuffling of how you do business internally. It's really mostly about internal processes, not necessarily about your bandwidth as far as access to capital, because access to capital is going to grow with you, and access to deals is going to grow with you. You don't have to worry about that. That's going to come naturally as you're growing and adding units and developing relationships, adding more debt partners, adding more equity partners. Obviously, you're going to have to, that's not going to come naturally. You're going to have to go out there and bust your butt to secure more equity investors into your deals. But the internal processes and the internal efficiencies, that's really the hardest part. And that's really what's going to be hard for us. I mean, we have to now kind of look at our internal structure. We're launching a fund next month, or we hope by the end of December, our new fund will be launched. And we really have to do some internal reshuffling. We have to look at responsibilities of people internally, what they're doing, who they're doing it with, what their titles are. Believe it or not, titles start to matter a lot more than before, because when you sit across an institutional investor who's going to sink in anywhere between 10, 15, 20 million with you, they want to know that there's a CFO on board, not just a somebody who controls your books. They want to see that someone has some kind of a COO responsibility, chief operating officer responsibility, as opposed to, Verna, the office manager, who takes care of it. So, so there's some internal structures that need to be in place in order for you to be able to accommodate that inflection point and move forward. And really, you're doing it not just for yourself. You're doing it obviously for yourself, but you're also doing it to make sure that you're creating credibility for those institutional investors, institutional partners, or strategic partners that are going to be coming on board with you. You start hitting those inflection points.
What was your first inflection point? At what number of units did you really see, wow, this is a big difference for you? Because I know 4,000, 5,000 is big. Was it 1,000? Was it 2,000? Or was that big first change for you?
I think the first one in any of us in this industry is probably the 1,000. The first inflection point is 1,000, because that's really the point where we started to because before 1,000, we weren't even managing. We didn't have a management company. We weren't managing our own units. We were subcontracting that out. We were a third-party manager. After we hit the 1,000 point, we started looking at the numbers and we thought, wow, you know what? It makes sense for us maybe to start managing our own units, because now we have a critical mass where we can actually leverage our processes, leverage our people, and see if we can create a management company that would be worthwhile to manage. So that was the first inflection point. The next inflection point was 2,000 units, and that's when we had to expand, create a separate company altogether for management. And really sort of upgrade who we work with from a partner standpoint, create HR functions, create internal sort of accounting functions, and now we're hitting that close to that 5,000 inflection point. Now is the next one, and that's the
How do you like that management company? I mean, Jake and I, we're always self-managing. We created the management company from when we first started. We just like the control. I mean, how do you like it once you created that management company? Do you like it better managing your own or farming it out to someone else?
Oh God, yeah. I mean, it's having your own management company, managing your own properties is if you can do it, and if you have the people power to do it, it's a no-brainer, because it's giving you tremendous cost control over what's going to, your turns, your maintenance, you control that. You're not paying someone 6%, and also on top of it, you're at their mercy is what they're going to charge you as far as turns or repairs or anything like that. Now you're still paying some of those costs, obviously, when you have your own management company, but you have a lot more control over those costs. You especially have control when you're buying in bulk. I mean, when we go out, when we have a contract with like a Home Depot to go out there and buy some pipes for them, they know that we're going to probably buy 1,000 pipes as opposed to going out there onesie twosie and buy 2 or 3 pipes. So the pricing is going to be much more advantageous. And frankly, from partnering standpoint, from going out there with investors, institutional guys, strategic partners, they love seeing people who manage their own property. In fact, some of them have that as a demand before they even partner with you. They won't even touch you if you don't manage your own.
That's great. That's an awesome point, Jake. I never thought about that because
the
they want control.
The control is key. I completely agree with that.
Yeah. Wow. Let me round this off with saying, what is your best real estate investing tip for the listeners?
Real estate investing tip: do your due diligence. I mean, that's to us, due diligence is key. I can't tell you how many deals we look at, and I can't tell you how many deals we pass. And do due diligence right to the very end. Don't just stop when you secure a property, when you do a contract on a property. A lot of people make the mistake of they do due diligence. They do financial due diligence. They look at a property, they look at the books, and then they decide, okay, this looks good. Let's make a run at it, and then they win the deal. And then they stop the due diligence. They don't make any more. They're like, oh, we won the deal. Let's just go through the motion and do a closing. You should really go all the way to to me, a deal's not done until you sign the closing documents and money's in the bank.
That's the truth.
Up to that point, for any reason you can pull out. For any reason, I mean, not for any reason, but for reasons that are stipulated in your contract. I mean, we've done, and we do, part of our due diligence is we do a walkthrough before we close. We do a walkthrough on all the units that we are under contract with. So if it's a 300 unit complex, we're walking 300 units before we close.
We do the same thing. I think it's great advice.
To see every single one. You have to, because we did one about 9 months ago in Charlotte. We had secured it. It was under contract, and we were moving towards a closing date, and we had the final inspection on it, and that's when we went to walk all the units. And 60% through the walkthrough, we decided to pull out of the deal because we saw some horrendous units that were not shown to us.
We've seen some with no refrigerators, no ovens, no kitchens. They're storage units. We stipulate in our contract, so we expect 100% rent-ready units.
Right.
So exactly. and that's key. I think people really need to write that down, because if you get in there and you have a vacant unit, meaning there's no fridge, kitchen, flooring, and they're using it for storage, that's big money to go in and turn that. So you got to really be careful of that.
Yeah, that's right. I mean, it could be anything. You could start walking around. They could have told you, "Oh yeah, we don't accept pets in this property." You start walking around and you see a ton of dogs. You're like, what the heck? You said you don't expect pets. What? I just saw like 20 dogs on my walkthrough. I mean, what?
Yeah, no kidding.
But John, could you have gone back on that property and said, "Listen, the price was $10 million. We're knocking off $500,000. Let's do that." Would it have been worth it to you to do that? I know we don't like to retrade in the business, but if all of a sudden you see a lot of stuff that are red flags, would you go back and retrade on that property if it made sense to you?
We gave the option in that particular example I just gave you in that property in Charlotte that we walked through. We stopped the tour we were supposed to go on until 4:00 in the afternoon. We stopped it at almost 12:30, and we went back to their office and said, "Look, we're not going to go any further because here's what we saw, and according to what we saw, there's a major disconnect from what you showed us and told us and what we're now seeing. So now the price goes from that to this. If you're willing to take it, we'll continue the tour. If not, then let's shake hands and walk away friends." And they didn't take it, so we said, "Okay, see you later."
It's frustrating though, isn't it? Because you spend the money on due diligence, you spend the money on contracts, you spend the money on inspections.
Better to cut it off now than.
I was just going to say, don't be pennywise and pound foolish. I totally agree, because if you don't buy right, which is one of the first stipulations we talk about, buy right, manage right, and finance. If you don't buy right, it's going to take you years, especially at the top end of the market. You're gonna be suffering, and you know how I know that, Jake? Because I've done that before, Jake. You don't want to do that because it's painful. You know what I'm saying? So
you don't ever want to fall in love with a deal. Don't fall in love with a deal. You can like it, you can love the numbers up to the point, but don't ever fall in love with just one deal, because it will affect you emotionally. You will not be able to do that walking away, and that's something that's been kind of ingrained in me ever since I was even doing stocks. One of my first mentors in the industry told me, don't ever fall in love with a stock, because that'll cloud your judgment, and it'll cloud your judgment for you and for your clients of when you can get rid of that stock. And that's always kind of stuck with me. I never fall in love with a deal, because that really clouds your judgment. No matter how good or how pristine the deal looked, and how much you really want to be in that area, and how much you really want to be in that neighborhood, if you fall in love with that, you're gonna make a mistake.
Gino knows what I'm about to say, but I'm gonna have you call my wife when we get off, because there's this house that she's killing me on right now, and I'm like, you gotta just be patient. She is killing me because she fell in love with this house, and man, she's just everything you said. She's emotional. She's got clouded judgment. I'm gonna have you call and do a little woosah session with her when we get off this thing.
It's real simple. I told Jake, she's selling you with emotion and closing you with logic. That's what she's doing to you. And I'm keeping an open mind, saying, what are the pros and cons? And she just loves it. And I said, listen, you got to do what she wants and just get the price down. And then he's got the ego going, I'm not going below this price. But I said, what is like 20, 30 grand in the grand scheme of things if you make her happy and all? And like you said, if you become emotional, you lose all sense of reality and all logic. And that's a really amazing point you make, but it's hard for a lot of people, because Jake and I, we fall in love with deals. We just fall in love with them, not because just the way that they can change our lives. We look at these numbers and the way they've been able to change our financial situation, and I think that's what we fall in love with more than the deal itself. And sometimes you have to separate that and go, wait, hold on a second, I'm not being rational about it. And I'm glad you made that point, because it is very difficult. And it also has to do with deal flow. You've got deal flow, so you're not looking at that one deal only, and if that deal craps out, you're done. You've got multiple deals you're looking at, which is important, guys. Continue to source those deals. Continue those broker relationships. Continue getting on buyers lists. Continue going on MLS. Send out direct mail. You want stuff coming inbound, because if your inbound marketing and inbound deals come through, that's what's going to happen. John's going to say you're going to fall in love with it, and then all of a sudden you're stuck. And then you're not going to pull out of the due diligence because you found a lot of stuff because you think you're emotionally attached. And it has to do with negotiation. The more time you're into a deal, the more you feel committed to it, the less you're going to pull back. So it's really important. The three things of negotiation: power, time, and information. That time one is really important, because if you're stuck and you're in love and you're emotionally involved, it's a lot harder to pull back. So I think that's just really wise advice. Thanks.
No, absolutely. Yeah, everything I just told you, you can take that and chuck it out the window when it comes to your wife looking at a house, man.
No shit.
That doesn't work. That does not work.
Guys, let's
make her happy is all I'm just make her happy is all I'm going to tell you.
That's probably the best advice I've gotten in a while, so I appreciate that. So, John, this is interesting, because I know that the majority, if not 100% of our listeners, aspire to be where you are someday. You know, they're looking and saying, if I could build a real estate portfolio like that, you know, and just get that financial freedom, that's what folks are here. They want to learn from people like you. So someone getting started, what is the best habit? You know, what do you think, something you do every day that's put you in the position that you're in right now? What's that habit that you could share with the listeners to say, this has been a difference maker for me?
One thing that I've done for years is every day I try to sort of do something outside of my comfort zone first thing in the morning. And it doesn't have to be necessarily for work. It could be for anything you personally. If you every day you wake up, take the dog out for a walk, come back to the house, brush your teeth, put on your clothes. Wake up one day and just go for a jog instead. You know, shake your body out of something else. If you usually come into the office and pull up your computer and check your email, come into the office and pull up your contacts and make a phone call to anybody, to somebody. You know, first thing in the morning, and see how your mind and your body reacts. You're really what you're trying to do is you're trying to trick your body into sort of this sort of jolting it into a completely different start, both from a mentality standpoint and from sometimes from a physical standpoint. And it really does wonder to your production for the rest of the day. Because we all like to fall into, we're a creature of habit. We like to come in, get our coffee, sit in front of our computer, check emails, check the Wall Street Journal, whatever it is. Change that. Change it at least 2 to 3 times a week. If try to do it every day, but if you can't do it every day, and I know it's hard to do it every day, try to do it at least a couple of times a week, where you come in instead of checking your emails and doing something lackadaisical like that. Pick up the phone, call some investors. Pick up the phone, call some brokers. Pick up the phone and call someone who will benefit you from a business standpoint. If you're at a stage where you're cold calling people, you can pick up the phone and cold call somebody at 8 o'clock in the morning. You'd be surprised, and they'd be surprised that they're getting a call from you. And it will really kind of set you, from a productivity standpoint, it'll set you off tremendously for the rest of the day.
That's pretty cool. That's the first time we've heard that one. Appreciate that.
Yeah.
What's the biggest mistake you've made in the real estate business?
Biggest mistake I've ever made in real estate business, probably falling in love with a deal. That's probably where we learned not to fall in love with the deal. Falling in love with the deal and just kind of sticking with it for a while. And unfortunately, the deal I fell in love with was large enough, and that was back when I had my over a year and a half, and it just didn't.
See that time?
Be objective.
Long time.
Be objective.
A long time. So I don't fall in love with the deal. Always have multiple eggs in a basket and just move on. Know when to cut the cord and move on.
Gotcha. Favorite business investing? A book. Anything that you can say. This book changed my life. I think you should read it.
Changed my life. I mean, there's so many. There are probably 2 or 3 books out that I would rank in the top echelon of the books I read, and I read a lot of books. The first one that comes to mind is The Tipping Point by Malcolm Gladwell. It's a great book. I don't know if any of you read Malcolm Gladwell. He's a really, really great author. He writes mainly about sort of the economic disconnection in society and in business. And The Tipping Point talks about this sort of point in your career, or we talk about inflection point, and we talk about this inflection point in the past. He talks about these inflection points, whether it's in your career or in your personal life, where you get to a stage where you can really move on to propel yourself to move on to the next stage, and what it takes to get to that. Another great book is Blue Ocean Strategy. It's mostly a strategy book, but it really talks about where you can build your business and what innovations you can do to go where no one else have gone, and to really find those niches in whatever business you're in that would create sort of new disruptive, what's called blue oceans. That was another great book, and another really great book that I really like now that I just finished recently a few months ago. It's called Grit by what is her name? The name of the book is Grit, and it's really talks about the power of perseverance and how you can stick to it.
It sounds cliche, but I have no doubt that was an awesome book, because that's been one of the things that is, especially in real estate, I mean, you got to hang in there and scrap in the beginning. So I have no doubt that book was probably really good.
It's really good. It's really good. So yeah, I would definitely recommend that one.
Cool. So, a lot of units under your belt. What has been the best deal and why?
The best deal. The best deal is always the latest deal, because it's
to get you juiced up, right?
Exactly. I mean, that's how it always should be in our industry. Your best deal should be your latest deal, because that's a deal that shows that you've wrapped up another arrow under your belt, and you have successfully, hopefully, made the right decision. This particular deal was in our case, I really believe that to be true. It was an off-market deal that we were successful attaining. It was the right amount of due diligence, and we kind of stuck to it. Another deal we did recently, actually, outside of that deal, we did a deal that we closed on a few months ago And when we first got into that deal, we discovered when we were doing our due diligence, we discovered that there were some major structural issues. And we went to the seller and told him that, hey, we discovered these structural issues. They're mainly support struts under walkways that were not permitted correctly. And we said, look, we love the deal. We love you. We are still willing and able buyers, but this has got to be addressed. And, we can't move forward unless this is addressed. He not only addressed the deal, he went above and beyond it. It took him a while. It took him about a month and a half to do the repairs. But he came back to us. He gave us more concessions, seller's concessions to stay in the deal. And we ended up getting about $200,000 or $300,000 repair out of it.
It's fantastic.
Free, but he really front loaded that.
Sure.
And we got a fantastic apartment complex that is that we don't have to do any of those repairs on. So that was a great, really recent deal.
I love that. Definitely been there a few times. And look, you're not doing the work, and you're not dealing with the contractors if it's outside your group. So that's good.
Yeah.
So let's dovetail then. What deal are you excited about right now?
Fun.
Right now, I don't have anything right now. We don't.
Gino, you got to send him something, man. You got to get something in the hopper for this guy here.
Well, I know John's setting up the fund, so that's got to be real exciting.
Yeah,
I mean,
what I'm excited about right now is the fund. I mean, it's not a particular deal, but what I'm excited about is launching our fund, and it's been a long time. We've worked on it for a while. There's been a lot of sort of sweat and tears and energy that went into it, into the preparation of it. We've switched around some of the strategic partners and some of the purveyors that we're using into the fund. We switched auditors a couple of times, but we're finally at a point where we have a solid team, and I'm excited to launch it. It's our first fund in the market. It's a small fund. It's going to be a $25 million equity fund, but leveraged, it's going to get us about $120 million added into the portfolio.
That's awesome.
So talk about the dynamics and the objective of the fund and how you're going to use it.
So the fund is really going to be creating ready to deploy capital for deals that we can pull the trigger on a lot quicker. It's not really changing our strategy. It's not, we're not switching gears and doing something completely foreign to what we've been doing for the past few years. We're doing the same successful strategy, the same successful due diligence that we've been doing for the past 9 years. We're just continuing it now. Instead of doing one deal syndication at a time, we're still going to do one deal syndication at a time. It's just going to be done within the fund. So the fund
money's going to be sitting there ready to go, ready to deploy when the deal comes. Is that
correct?
Fair? That's awesome.
The fund itself will have capability of doing JV deals as well. So we are still going to be open to doing joint venture deals with people within the fund. So the fund could be one of the JV partners in another deal, as long as the returns and the upside is obviously calculated to the fund. So there are a lot of things that we're going to be. I mean, this is going to be the only vehicle for us to work with investors moving forward. They will not have the option to do a single syndication outside the fund. Everything that we do moving forward is going to be done within the fund.
Cool.
Hopefully we, knock on wood. Hopefully we wrap it up pretty quickly. In the next, we hope that we can finish the fundraising in about 10 months, 12 months, and then move on to fund 2.
That's
very
awesome.
Cool.
Congrats.
You guys ever? This is just a kind of a question that Gino and I have been going back on because we consider some of this stuff. You guys ever, when you're doing a syndication, refine the LP out of the deal, or is it typically you guys just selling at that point, or are they continuing to hold?
So our typical hold is 3 to 5 years, but a lot of times it depends on the market. Right now, we are actually going through a recapitalization deal on 5 of our assets. Because they're cash flowing like crazy, and we can't replace them with something similar. So we chose these 5 assets because the cash flow is just fantastic. We don't want to get rid of them out of our portfolio, but we've gotten to a point where now we have very low debt on them, and we want to keep them. So we went to the market and we did a recap deal on them. We're hopefully hoping to close on that recap deal hopefully also next month. And kind of keep them in the portfolio, but at that point we own them almost 100% owned by us, and we're going to probably use some of them to actually seed the fund as far as assets.
Awesome. Yeah. That's really cool.
That's great.
Yeah.
Man, I think the one of the best things that you said in the beginning was just the real estate. You can allocate a little and get a lot. That is so true, and that's the first time I've heard anyone say that. I mean, I think people talk about other people's money, OPM, and all that, but that is so true, man. That is great. And I really liked what you said about doing something in the morning to get out of your comfort zone, kind of jolt the body and the mind to start thinking differently. And obviously, don't fall in love with a deal. I think that was it's pretty appropriate.
Make the wife happy.
Gino, have you read this Blue Ocean Strategy? I've never heard of this one.
No, I haven't actually.
I'm gonna check that out.
Down. Yeah, I wrote it down.
So, man, this has been awesome. I got to say this before we hop off because Gino gets mad at me. Guys, if you have not liked our podcast, get on there and like it. iTunes. John, if there's a, I don't know if there's a way, but is there, if someone wants to invest or just, work with you closer, is there a way for investors to get a hold of you or?
Yeah, absolutely. My email is John, JOHN at maccvp.com, macvp.com, or our website is macvp.com, maccvp.com, or you can hit me up on, any of the social networks out there, Twitter. My Twitter handle is Business Anarchy, Business Anarchy.
Bring the pain.
And
like that.
Yeah.
I like that.
So any of those things, people can hit me up with.
Man, I feel like I'm slacking right now. I got to go get a fund started and start some of these syndications and go knock out about another 20,000 units here. So, man, this has been great. I really appreciate you coming on the show.
You can do it.
That's right. John, thanks for taking the time. I learned a lot. Make the wife happy and just make your goals really big. I like that.
There you go. If anything you got out of this, make the wife happy.
Big goals, bro. Big goals. Thanks for taking the time today. I had a great time.
Thank you so much for having me, guys. I appreciate it.
We trust that you enjoy the Wheelbarrow Profits podcast. Visit jake-amp-gino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.